Now is the start of what we call the earning seasons. Companies release how much money they earned during the last quarters, and analysts try to forecast, for example, what is the earning per share, how many sales they've made, how much revenue they earn. And for traders, earning season is a great opportunity so as to try to take advantage of a lot of volatility. And in this video, I wanted to share with you how I personally trade earnings, what are the things that I'm looking at, how I actually take some trades. So hopefully it's useful for some of you who'd like to do the same. But before diving into this video, if you find this video interesting or helpful and you actually learn anything at any point of the video, please consider subscribing to my channel. It's free, it helps me a ton, you can't imagine. The first thing that you need to understand about earning announcements is that when a company releases how much revenue they earned during the last quarter, it has for effect to create really a lot of volatility in the market and for that particular stock. And the reason for that is that everyone tries to predict where the stock is going to go. Hence, a lot of people are going to buy calls and puts because they respectively think that the stock is going to go up or down. And that has for effect to increase the volatility in the market, and especially for options. And that, as a consequence, has for effect to increase the option prices because more and more people are willing to buy options, then the prices of those same options are actually going to increase. That's really the law of supply and demand. The more people are willing to buy something, the more expensive that thing is going to become. And the less people are willing to buy that same thing, the cheaper that thing is going to become. And the best proof to see that option prices are actually increasing, you can really see that by looking at the implied volatility. If you take a stock and you look at the implied volatility prior to the earning announcement, you can see that the implied volatility rises and rises up to the moment where the earnings are actually released, and directly after you can see a drop in the implied volatility, often called IV crush. And the implied volatility is a translation of option prices, meaning that the more expensive the option price, the higher the implied volatility, and the cheaper the options, then the lower the implied volatility. And you can really see this effect with earning announcements. And if you see that the implied volatility is rising for a certain stock, you can know that the options are actually getting more and more expensive. And when you see a big drop in the implied volatility, what we call the IV crush, it refers to a sudden drop in the option prices. And you can see that over and over and over. That's a natural phenomenon that stocks are actually going through. Every time there is an earning announcement, the implied volatility is going to rise prior to the earning announcement, proof of the option prices getting more and more expensive up to the moment where the earning announcement is released, and directly after that you can see a drop in the implied volatility, the IV crush, proof of a drop in the option prices actually getting cheaper. And I'm not sure if you ever noticed, but if you try to buy a call or a put during an earning announcement and then the earning is actually released, you can still lose money even though you were right in the direction of the stock. Meaning that let's say that you buy a call for a certain stock and then when the earning is released, the stock actually goes up but you still lose money. And the IV crush is the reason for that. That's why even though you buy a call or a put and you're right in the direction eventually, you can still lose money because of what we call the IV crush. And the reason there is an IV crush in the first place is that because everyone tries to speculate on where the stock is going to go with the earning announcement, there's a lot of speculation creating a lot of demand for options, increasing the option prices. As I said before, when there's a lot of demand for a certain product, that product is going to get more and more expensive. And the less demand for that product, the cheaper that product is going to become. When the earning announcement is actually released, there is no point anymore in trying to predict where the stock is going to go, as it's already passed. Hence why the demand drops so much all suddenly. And this drop in the option prices is really the core of what I'm trying to do when I'm trading earnings. I do not want to buy options or calls or puts when there is an earning announcement because of that drop in option prices. On the opposite, I'm trying to take advantage of it by selling options. So instead of losing money by having this IV crush hurting my calls and puts, I actually take advantage of them by selling options. By the way, if you're just starting out with options and you really have a small account, meaning that you cannot afford to buy stocks that are very expensive, I have a very good news for you. If you use the first link in the description and you open an account with Webull and deposit $100, then you can benefit from 4 free stocks that will be given to you with a value up to $1,600 each. So make sure you sign up with the link down below. And as I said, instead of buying options, I'm trying to take advantage of earning announcements by selling options. And the strategy that I like to use is called the short strangle. A short strangle is selling a call and selling a put at the same time. And that has for effect to create a profit zone, as you can see right now. That profit zone means that if the stock stays within that zone, I'm going to make money. And if the stock goes out of that zone, I'm going to lose money. Hence, I'm not betting on the direction of the stock. I'm not saying that the stock is going to go up or down. I'm betting that the stock is going to stay within a certain range after the earning announcement. And one particularity of that strategy is that it has an undefined risk, meaning that theoretically your risk is unlimited. Hence, if you're not fine with it, you can use the alternative, which is a short Iran condor, where your max loss is actually defined, where you have a max loss on the trade. The reason I prefer to bet that the stock is going to stay within a certain range, and once again that's only my opinion, is because I feel a lot more comfortable betting that the stock is going to stay within a certain range rather than trying to bet on a direction. I don't really believe that we can predict where the stock is going to go anywhere, especially with earning announcements, and I'm sure that you noticed that even though a company might have beaten its predicted earnings, the stock can still go down. Let's see an example of a short strangle so you can really picture how I actually do this. And if it's still unclear, stay with me because now we're gonna start looking at examples so it makes perfect sense for you. So let's take the example of Morgan Stanley. They are releasing their earnings on Wednesday. Let's see how I can use a short strangle for that particular stock. The first question that we might ask ourselves is, which expiration should you choose? Well, I think that the best expiration to choose is the closest one. If you have a stock that has their earning announcements this week, for example, the volatility is priced in for this week, meaning that all of the demand for options are actually for this week because the earning announcement is on Wednesday. It makes much more sense to trade this week's expiration and not, for example, the one in 2 months time. Hence why I like to sell strangles on the week's earnings where there is the earning announcement. It makes more sense to me at least. And to be really clear on how I personally like to sell my strangles, if the earning announcement happens on Wednesday morning prior to the market opening, then I'm going to sell my strangle on Tuesday before the market closes, hopefully to buy it back on Wednesday when the market opens, hopefully at a cheaper price, and so to make a profit that way. And why? Well, as I said, the options are increasing in price right until the moment the earning announcement is actually released, and then you have the IV crush, which is the option prices dropping very significantly and suddenly. Hence, it wouldn't make sense, for example, to sell my strangle after the earning announcement is actually released. And in our case, as the earning announcement for Morgan Stanley is being released on Wednesday prior to the market opening, then I need to sell my strangle on Tuesday before the market closes so I can actually have my position being open while the earning announcement is actually released. And the other case is if there is the earning announcement that is being released after a market close, then I'm going to sell a strangle right before the market closes, hopefully to buy it back the next day when the market opens. And the reason for this is that I really want to sell options when the options are the most expensive prices. Hence, I'm not going to try to sell the option, for example, on the Monday if the earning is on Wednesday, because the prices for options could still increase up until the day prior to the earning announcement. Hence, I like to do it just before the market closes so I can make sure that I sell options at their most expensive prices. Now that we solved the question on which expiration do I choose and when do I sell actually my options, which strike prices do I personally like to use? And this one is very particular because when you sell a short strangle or a short Iran condor, your profit depends on how wide is actually your profit zone. The wider the profit zone, the smaller the reward, and the tighter the profit zone, the bigger the reward. Because think about it, you're not going to make a lot of money if you only take trades that have 99% probability of profit. It would be a bit too easy otherwise. Compared to someone who only takes trades that have, for example, 20% probability of profit, then you have the potential of making much more money there because you have much less chances of being right. Hence, how I personally like to sell strangles, I personally like to choose strikes that offer overall for my trade a probability of profit of around 80%. And the reason for that is that I think it's a good balance between the probability of profit and the reward that I'm getting if I'm right on the trade. And that's always this balance between the probability of profit and the reward that you're trying to play with when you're trying to trade options. Either you're right all the time but you make very little money when you're right, or you're not right a lot of times but when you earn a lot of money. And that's always how it works with options. And for those who know standard deviations, I'm going to sell a call and a put at the 1 standard deviation mark. That's going to give me in general a probability of profit of around 80%. However, if you don't do what I'm going to tell you right now as a following step before taking any trade, I can assure you that you will lose money overall. And now, the most important thing of that whole strategy, even prior to taking a trade, and if you don't do this following step, I can assure you that you will lose money. As I said, I'm betting that the stock is staying within a certain range. Hence, I want to make sure that the stock that I'm going to trade has the best chances of staying within that range. And for that, we need to understand that there are stocks that usually have for habit to move more than others during their earnings. For example, if you look at tech stocks like, for example, Cisco, Zoom, they have for habit to move a lot more during their earning announcements. As I'm betting that the stock is going to stay within a range when I'm trading earnings, I want to make sure that this stock that I'm trading has for habit not to move too much during earnings, because otherwise it goes a bit against the purpose. If I'm betting that the stock is staying within a range and I'm trading a stock that has for habit to move a lot during earnings, I'm already killing myself right from the start. And I don't know why no one talks about this, honestly. Like, I've been trading earnings for a long time and no one ever told me this. I had to discover it by myself, and then I'm sharing it with you today. So please consider subscribing and liking this video if you actually like what I'm going to tell you, because this is so important. To understand how volatile is a stock during its earning announcement, I use a website called optionslam.com. I don't even use the paid version. I actually only use the free version. And when you go on that website and you type a stock, for example, Zoom, and when you go on the web page that comes up when you type a stock, there is something called the EVR. That's an indicator that says how volatile is a stock during its earning announcements. That's graded from 1 to 10. The closer to 1, the less volatile is the stock during its earning announcement. And the closer to 10, the more volatile is the stock during its earning announcements. And typically, I don't like to trade stocks that have EVRs above 2. By trading stocks that have EVRs less than 2, I'm really focusing on the ones that have very low volatilities. And I love this. And honestly, this changed so much in my trading performances. When I started focusing on stocks that had low volatility during earnings, my performances really improved a lot. Because the problem is, I didn't check that before. I was trading stocks that have very high volatility for habit during their earnings. And I was getting burned like this and I didn't understand why. And I don't know why no one talks about this, because this is so important to check. But of course, this is not a 100% foolproof system, meaning that sometimes you have a stock that usually has for habit not to move too much, while once in a while it's going to move a lot. But you can be sure that overall, if you focus on stocks that has, for example, EVRs less than 2, usually is going to be stocks that have very low volatility during their earning announcements. And now that you understand how I check how volatile is the stock prior to taking a position, which strategy I'm using, which expiration, which strikes, there's now the profit target. And regarding the profit target, I always like to focus on 50% profit targets. If I can have more, I will take more, but overall, I'm focusing on 50% profit targets. Usually, you'll see more in my group Option Trading 101 saying that I got more on certain trade, but usually I'm trying to focus on 50% profit targets. And now that you understand all the theory behind it, I want to show you some live examples so you can see what you can expect from using this strategy. So as you can see, I do this over and over, and if you check each stock on, for example, optionslam.com, you're always going to see that the stocks that I'm trading have EVRs less than 2. That really ensures me that I'm trading low volatile stocks. So as you can see, when I sell a Strangle, I receive a credit, and when I buy it back, I pay a debit, hopefully at a cheaper price, so I can make the difference in profit. So as you can see, I do this on stocks like Coca-Cola, Intel, American Express, and a lot of other ones. And I do this every earning seasons. I really shared my whole workflow and thought process in this video, and I really hope that you have found this useful. If you have liked this video and see how I personally trade earnings, please consider liking this video and subscribing to my channel. As I said, it's really the best support you can give me, and I'd really appreciate it. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.